I recently reduced my exposure to US equities at relatively high levels, not because I believe the market is about to collapse, and not because I think the AI story is over, but because the structure underneath this market has changed. We are no longer in a simple trend-driven environment. On one side, artificial intelligence continues to drive massive capital inflows and earnings expectations. On the other side, long-term interest rates have moved back to levels that materially change valuation assumptions. At the same time, energy prices are rising again, driven by geopolitical uncertainty, and inflation risk is no longer a background variable. It is becoming central again. When these three forces interact, AI growth, rising yields, and energy-driven inflation markets stop behaving like a one-directional bull trend. They become a tension system, and in a tension system, positioning matters more than conviction. So this is not a market call. It is a risk adjustment, a decision to step slightly aside and observe how this structure resolves itself. Because in markets like this, the most dangerous position is not being wrong. It is being fully exposed to a regime that is changing while still believing it has not changed yet.
EPEAI vs oil, the market collision. Artificial intelligence has been the dominant force in U.S. equities for over a year, but over the past few weeks, a second force has re-entered the system: energy. Crude oil has surged back above the $100 level, driven by geopolitical tensions and supply uncertainty. At the same time, long-end yields have moved sharply higher. This creates a direct conflict in the market structure. AI-driven equities depend on one critical assumption: declining discount rates. But rising oil prices threaten to reverse that assumption through inflation. This is the key tension. AI requires low inflation and lower rates. Oil is reintroducing inflation risk into the system, and when inflation re-emerges, it does not just affect commodities, it reshapes the entire valuation framework of equities. We are now seeing the first signs of a structural collision between the AI narrative and the energy cycle. EPR, the global bond market break. The most important move in global markets is not happening in equities. It is happening in bonds. US long-duration yields have surged to levels not seen since before the global financial crisis. Similar moves are occurring in Japan, the UK, and across Europe. This is not an isolated repricing. It is a synchronized global shift in risk-free rates. When long-term yields rise, every asset class is affected: equities, real estate, private credit, and infrastructure. But the most sensitive asset is long-duration growth equity. Because AI stocks are fundamentally long-duration assets, their valuation depends heavily on future cash flows. What the bond market is telling us is simple: the cost of time is increasing again, and that changes everything. EP3 is AI 2.0 bubble. On the surface, markets remain strong. Concentration is extreme. A small group of mega-cap technology companies is driving most of the index performance, while the majority of the SP 500 is lagging. At the same time, AI capital expenditure continues to accelerate at record levels. The risk is not that AI is fake. The risk is that expectations are being pulled too far into the future. We are entering a phase where investment itself becomes a driver of reported growth. That creates a feedback loop. Higher investment, higher revenue expectations, higher valuation, more investment. Historically, this structure resembles late-cycle technology expansions. The question is not whether AI is real. The question is whether pricing has moved ahead of reality. EP5, the commodity signal reversal. In a traditional inflation regime, commodities and gold tend to rise. But recently, we have seen a broad decline across gold, silver, and industrial metals such as copper. This signals an important shift. The market is no longer trading inflation as growth-driven. It is now trading inflation as a constraint on financial conditions. Higher yields are beginning to dominate commodity pricing. Even copper, often considered a proxy for AI and infrastructure demand, is weakening. This suggests a transition from inflation optimism to liquidity tightening concerns. And that transition is historically one of the most sensitive phases for risk assets. EP